Did you know that even during major wars or crises, investments historically bounce back, and sometimes even accelerate? Imagine waking up tomorrow to alarming news and thinking, now what about my money? Well, you're about to discover solid, data-backed strategies to protect and grow your wealth during global turbulence. So go ahead, hit the like button, subscribe, and turn on notifications. This video might change how you invest. This video is urgent, born from real concern about rising geopolitical tensions. With the current global landscape becoming increasingly complex, it's more important than ever to stay informed and prepared. Our goal is to provide clear, calming financial guidance, focusing on what truly matters and cutting through fear-driven headlines and clickbait. The core message: no matter the chaos around you, staying calm, strategic, and disciplined is what protects your wealth. It's not just about reacting to fear. It's about acting with intelligence and foresight. The first step to coming out stronger from any crisis: rational financial decisions. Avoid panic selling or letting your judgment be swayed by headlines. Stick to data and structured planning. Market behavior during wartime. History reveals a clear pattern: sharp drops, followed by quick recoveries. These moves reflect both collective fear and the resilience of investors who believe in recovery. Historical examples: Pearl Harbor, 1941 market fell 3%, but recovered within a month, a classic case of overreaction corrected by economic fundamentals. Cuban Missile Crisis, 1962 drop of 7%, recovery in 12 days. Even under nuclear threat, markets normalized fast. Ukraine invasion, 2022 initial dip, then recovery in about a month. Markets reacted to uncertainty but didn't stay down. Takeaway: markets fear uncertainty more than conflict itself. Once timelines and consequences become clearer, investors start looking beyond the crisis. Conclusion: don't abandon your investments out of fear. The market seeks balance, and panic selling might cost you just as a recovery begins. Past economic crises and recoveries. In 2008, during the biggest crisis of the century, markets dropped 57% but tripled over the next 10 years, showing how painful shocks can still lead to long-term growth. After September 11, 2001, Wall Street fell 11 to 14% but recovered in just 2 weeks, a fast, effective response to trauma. The 2011 U.S. credit rating downgrade led to a 6% drop, but markets stabilized in 6 months, proof that even worst-case scenarios pass. The COVID-19 pandemic pushed the S&P 500 down 34% in just 33 days, but the full recovery took only 5 months, thanks to fiscal and monetary stimulus. Black Monday in 1987 saw a 22% single-day crash, but the market doubled in just 2 years, showing that even extreme events can have short-lived effects. The 2011 European debt crisis caused a 20% drop, but markets recovered in 12 months, highlighting how systemic risks can be resolved through coordinated action. These examples show that no matter how distant or domestic the crisis, global markets tend to follow the same path: sharp fall, adjustment, and steady rebound. Investment strategy comparison hypothetical study. Brittany tries to time the market. She bets big at the bottom, but risks misjudging it and investing right before another drop. Tiffany does the opposite. She buys during hype, when prices are high, and panics during dips, leading to frequent losses and frustration. Sarah uses the power of dollar cost averaging, investing a fixed amount each month, no matter the market condition. This consistency helps her avoid extremes. Real-world results. Sarah builds more wealth over time, like planting a forest. Some trees grow fast, others slow, but the forest thrives as a whole. The takeaway? Consistency beats trying to time the market, which often becomes an expensive guessing game. Bottom line: better to be steady and patient like Sarah than anxious like Tiffany or overly bold like Brittany. Why staying in the market matters. According to J.P. Morgan data, 2003 to 2022, a steady $10,000 investment would have grown to $64,000, proving the power of staying invested through all conditions. Missing just the 10 best days cuts your return in half, showing the real cost of trying to dodge downturns. Miss the top 20 days, and your investment barely grows, because those big days drive most of the gains. The best days often come right after the worst. Panic selling means you missed the comeback. Long-term return charts show that crises are part of the journey, but recovery drives the upward trend. Time in the market beats time in the market. Stay invested pays off exponentially over time. My personal strategy. My current approach includes consistent monthly contributions, using dollar cost averaging to smooth out entry points. I diversify globally, U.S. stocks through ETFs, international real estate via funds, and a small allocation to Bitcoin, spreading risk across assets. I have a strong emergency fund, covering 6 to 12 months' expenses. This lets me keep investing even in tough times without needing to sell. I do semi-annual reviews, rebalancing my portfolio, adjusting overweight assets, reallocating gains, and staying aligned to my risk profile and goals. Geopolitical view. Iran is internationally isolated and lacks the capacity to trigger a global war. Russia is stretched thin in Ukraine and unlikely to escalate beyond its region. China faces internal economic and demographic challenges that limit external aggression. The U.S. pursues containment and diplomacy, not open escalation. Don't panic over sensational headlines. Stay disciplined. Keep investing and review calmly. Avoid impulsive decisions based on the news. Rely on data and planning. Trust the process. Time in the market wins. Here's what you've learned today. Markets fall fast, but they always recover. Consistency, DC, outperforms any perfect timing. Being out of the market is risky. You miss the best days. Global war is scary, but World War III is unlikely. Your strategy should be based on calm, not fear. Put this into practice today. Set a monthly investment amount and choose assets you understand. Strengthen your emotional resilience. Control fear to make smart financial choices. Remember, time in the market beats timing the market. If this video gave you clarity, leave a like, share your biggest question in the comments, and send to someone who needs to hear this. Your financial freedom journey starts now. Click the link in the video description to unlock the ebook packed with investing insights, mindset shifts, and wealth building strategies.